Hi, everyone. This is Ben from TechSoup Canada. It's my pleasure to introduce our webinar speaker for today, Phil Downe. Phil is an IT negotiation specialist working out of Niagara-on-the-Lake, Ontario. His company is Relations Management Group. He brings a ton of private sector experience, getting his start in the late 70s in Montreal at IBM, first in his class at their account marketing school and a top sales representative. But then he decided that his skill sets would be more practical and useful on the other side of the table. For the past 30 years, he's been helping clients negotiate better IT deals. And I know Phil, and we worked together on and off over the course of about a year. And what I really love about Phil is his passion for making sure that the nonprofit sector is getting a fair deal when dealing with IT companies and vendors. I and the rest of the TechSoup team refer to him as the Dark Knight of IT negotiations because it seems like he's really out there. He has our back and he knows how to make sure that we're all getting a fair deal. Phil also writes a regular blog about IT negotiations on the website canadianaccountant.com. He has dealt with just about every major software company. He's published plenty, and he is a really good resource around software negotiations. So I'm very happy to introduce Phil Downe.
Ben, thanks so much. Now, for those of you who are familiar with these TechSoup webinars, that was more of a brief introduction than Ben's usual intro. For our other guests that are not familiar with TechSoup, it's really a remarkable organization. In North American business circles, as observed by Professor Kenneth G. Brown, we often see plenty of evidence of an individualist culture. It's all about me and what is best for advancing my career and my prosperity. And here at TechSoup, it's more about adhering to group norms, a collectivist culture. Business professionals helping nonprofits get free or at least heavily discounted software so that they, in turn, can provide better support for their constituents. I welcome the TechSoup members and thank you all once again for the incredible work you do. Now, in addition to our participants from the nonprofit sector, we also have several guests from the private sector. The Ontario Public Buyers Association, the private equity sector, and accountants from CanadianAccountant.com. It's a very impressive wide range of organizations, companies, and individuals who have registered for today's session. Collectively, as business professionals in information technology, one of our key duties is to anticipate and adapt to technology changes that will bring business efficiencies to the organizations we work for. The change I'm referring to is cloud-based software. Now, for TechSoup nonprofits, that cloud software is supposed to be free. But often that is not the case, and only the basic functionality is free. Or for some of our other guests, your first subscription agreement, and only the first one, will be very attractively priced. But it's software. There are always additional costs. Some are known and predictable, and the IT vendor parades them about. But others are hidden, and buyers get ambushed with those additional costs all the time. Now, let me tell you a story, and I'm sure everyone can recognize the pattern. I was asked to assist on a new customer relationship management, or CRM, deal in late 2016. The nonprofit will remain anonymous, but they selected a good, customized for nonprofits CRM solution, which had its base IT vendor software in TechSoup's portfolio. And the reseller in this case only worked with nonprofits. The reseller positioned themselves on their website as fellow philanthropists. They were anything but. I asked, where does the free software come in? They said the IT vendor provided the starter package for free, but it was the reseller's add-on, custom layer of subscriptions that provided all the needed functionality. The free IT vendor subscriptions were valued at $3,000 a month, but the reseller's subscriptions added another $7,000 a month. The reseller's implementation services were also estimated to take over 2,000 hours at $200 an hour. And there was no budget overrun protection. The nonprofit would just keep paying the full hourly rate until the work was done. Then the data storage charges were discovered to be over $1 per gigabyte per month. That's 40 times higher than what AWS charges for similar storage. Then the reseller tried to sneak in an annual price adjustment clause for consumer price index increases, or in case the IT vendor raised their base subscription price in the future. I said, I thought the IT reseller software was free. No, not once you go over 300 users, then you must use the extended version, and there is a charge for that. This happens all the time. You cannot avoid many of these similar situations if you cannot anticipate them and quantify the risks. Unfortunately, in many organizations, the people tasked with buying the software or renting the subscriptions do not have a good grasp for the potential pricing variability and dynamics of what they are buying and what to watch out for. They quickly lose sight with opaque and bundled IT vendor price points. They sometimes buy too much, creating unused software or shelfware, or they buy too little, creating potential compliance issues and financial exposure down the line. This leads most organizations, even if they think they got a decent first deal, towards eroding discounts and price increases to eventually overpay for the software. Sometimes the procurement people negotiating the deals and the corporate lawyers reviewing the agreements are not familiar with the vendor ploys, the consistency traps, and the normative standards. So they don't see the cost-saving opportunities and the price gouging traps. They leave too many pitfalls or IT vendor opportunities in the agreements for the IT vendor to eventually increase their prices and deplete your IT budgets. This happens most often when adding additional capacity during the agreement term, adding additional modules, and especially when renewing the agreement. Recent studies have shown that even among similar organizations, some spend up to 10 times more per user on software licenses than their counterparts. The savings potential is huge. And think of all the other things you can do in IT with that freed up budget. If you are a nonprofit, TechSoup can help you with a lot of this software. But no matter who you work for, it's you that must take the time to plan and prepare a successful negotiation strategy and realize our common goals. To unlock value in your organizations and stretch your IT budgets to accomplish more whenever possible. And keep in mind, the IT vendors are typically global and making the same strategic cloud products, marketing the same strategic cloud products in every corner of the world. So despite the variety of organizations represented here today, all of you are most likely facing the same major IT vendors, pushing the same strategic products, and experiencing similar negotiation challenges. The good news is the software is always improving and hopefully coming down in price. The bad news is your vendors will always try and maximize their profits. You must consider the obvious disadvantage at the negotiating table. Those IT vendor sales teams are made up of highly trained reps, managers, and executives who sell the same strategic products every day. Those IT vendors have developed deep and consistent expertise on how to construct contracts and how to maximize their profitability. The probability for a level playing field at the negotiating table is very low. Vendors have a written process. It's practiced relentlessly. It's repeatable and it is improvable. Plus, they have a well-defined strategy for executing it. When it comes to the development of their licensing metrics and agreement terms, they are purposely complex, often ambiguous, and designed to be opaque to prospective buyers. Plus, the products and licensing metrics and rules change consistently. By definition, we as buyers can never be as up to date as the sellers. Not even the largest multinational corporations can afford the time to keep up to date on all the software alternatives and changes across dozens of IT vendors, and also take the time to sufficiently prepare for every negotiation. Competence and confidence can only come from multiple experiences. When you are constantly exposed to various challenges and have found unconditionally creative solutions to resolve them. And it's not always easy. It's not meant to be. The IT vendors will not allow it to be. Every time a buyer complains to the prospective IT vendor and says, "Why do you have to make this so complicated?" the IT vendor pivots in a positive direction and deflects the blame on the marketplace. They say, "Oh, our 40,000 global customers demand the flexibility to buy our software in many different ways for many different applications. They blame you for the complexity." It just adds to the confusion and makes planning the RFP, comparing the alternatives, and buying the software much more difficult. But good preparation is key. Let me tell you another story. In February 1991, General Norman Schwarzkopf led a ground assault called Desert Storm to liberate Kuwait. The battle was over in a record 100 hours. When he was later interviewed about his preparation leading up to such a dominant victory, he was asked if everything had gone exactly to plan. "No," he replied, "nothing had gone to plan. But in preparation, they had drawn up a dozen battle plans, and that kind of preparation helped them adapt quickly to the changing situation on the ground and capitalize on every opportunity leading to the decisive victory." The more you do software deals, the better prepared you will be, and you'll get better results. Having a solid purchase plan, usually laid out within the RFP, with follow-up clarification sessions, mandatory pricing clarity, license transparency, and viable alternatives helps level the playing field. It's all about preparation. No matter what surprises the IT vendor throws at you, you are more likely to identify the situation clearly and pivot more often into new and more successful directions. This brings us to the question of timing and leverage. The top line represents your leverage strength, curving down as the negotiation progresses. The bottom one, rising steadily, is the IT vendor's leverage. Sitting at the negotiating table late in the process after the zone of consideration, when your leverage is low, is not the time to be receiving and processing new information from the IT vendor. You have to get as much information as early as possible, and definitely before you get to the negotiating table. Negotiations, by their very nature, are confrontational. The word negotiate comes from the Latin neg, meaning not, and otium, meaning leisure, and it's really not leisure. Some buyers are very uncomfortable at the table, and the IT vendors use that to their advantage. This is where I spend all of my time. The price points and issues to be negotiated are next. Software negotiations are excellent opportunities to drive down initial costs and also set yourselves up for constant future improvements. The most common areas to be negotiated within a software agreement are pricing, including pricing transparency and flexibility, and we'll get into more detail shortly. Then price protection for both growth and renewals. Professional services based on the SOW or statement of work, including training and travel and living expenses. The length of term and extensions or renewals. Data storage and transaction charges, which I like to call death by 1,000 cuts. And the legal agreement. Some of these areas will be more or less important depending on your interests and priorities, but this is a typical first step in preparing any software negotiation. In fact, all these should be addressed in the RFP. Once you have identified the issues or interests and prioritized them, you end up with what many call a wish list of trades. The things of low priority you might just give up in exchange for something of higher priority. And the list is dynamic. It can change easily as the negotiations progress. You never go into a deal without identifying your highs and lows or your zone of agreement for each issue. You're going to face all these issues, and you need to have a strategy to claim the most value out of each. Your vendor has a strategy that I alluded to a little bit earlier. They have a sales strategy that got them to the table. They have a negotiation strategy, and they have a step-by-step process to execute that strategy. You have to be equally prepared. In general, the global collective IT vendor sales strategy is to move everyone to the cloud. That not only changes the way the technology is delivered, but concurrently, it caused IT vendors to completely revise their revenue strategies. It's no longer the big upfront perpetual on-premise license fee and then annual maintenance fees for life. So an entirely new type of software contract emerged. The one thing that didn't change, however, is the IT vendor's absolute need to recognize revenue. They incent their representatives to maximize revenue to make their quarterly targets by closing deals aggressively. But they also understand the lifetime value of the customer. As aggressive as they can be, they will never risk doing anything that can lose the deal. IT vendors will go to extraordinary lengths to prevent a loss and to secure the sale before the end of the quarter, especially for year end. Now, last month was the busiest month of the year for Microsoft. June 30th is Microsoft's year end, and they have given so many huge incentives in the past to close as many deals as they could for year end that there are more renewals in June than any other time of the year. The big concern for you is some of the most consequential terms are often buried in the add-on license terms and renewal provisions. I have had many engagements from clients who received financial shocks when the renewals came up because they had not negotiated airtight provisions in these areas, despite the initial deal having been a seemingly good one. Now let's get into the weeds a little and get into some pricing detail. In more cases than not, when any of us negotiated a software deal in the past, we would tell the vendor exactly what we wanted. And eventually we would get it down to the total net cost, usually in some kind of opaque bundled price. You must discourage bundled pricing. If you allow it and accept bundling, the IT vendor will never provide a clear breakdown of the individual sub-price points. You run the risk of not knowing exactly what licenses you are renting and what the price points are for each. How can you negotiate a fair price for any add-on licenses or have a good benchmark for future price negotiations if you don't know the initial sub-license pricing? Get clear definitions for each subscription type. You must know exactly what functionality and what versions you need. Cloud subscriptions also come with dozens of different modules in many flavors, from restricted function like read-only to full function enterprise type subscriptions. Vendors all oversell. More modules than you need, more expensive license types, and more volume of licenses than are needed. You must get transparent pricing detail right up front. These deals fail in the beginning, not the end. Get bigger discounts for higher volumes and ask for multiple clip levels. Ask for clip level pricing below your anticipated needs and up to 10 years of growth. If you think your requirement might be 200 users, ask for clip levels starting at 50, 100, and 200, etc. Consider proposing a lower than necessary subscription start volume. There will be several better opportunities for improving discounts as you add more vendor revenue with more subscription volume later. Ask for additional discounts for multiple products. Press for discretionary discounts for a deal prior to the end of the quarter or for being a reference account. You have to get to the true net cost of each sub. You will need it to secure both add-on pricing and future price caps. Now you have the basis for negotiating some price predictability for growth and renewals. I warn you, this could be tedious. Vendors will resist giving you too much pricing detail. During the initial negotiations, but a little later in the game, once you have the real net pricing, you must steer the discussion towards your renewal options. If the vendor resists renewal price protection discussions, just tell them. To compare them to their competition, you will then use their full list price with a 5% annual price increase over a 10-year period. Explain that without future renewal transparency, their proposal would be grossly penalized compared to the others. If you have initial pricing transparency, you now have a strong footing for your future price protection provisions. Now, during negotiations, you can't make any of these arguments effectively unless you have precise price point clarity. Never leave yourself without some objective criteria to persuasively argue for better add-on or renewal pricing. Never accept soft assurances or conditional assurances. You could end up in a software hostage situation. Get your concessions in writing and make sure they are all reasonable in the circumstances. There are so many ways to protect yourself if only you have the time to prepare. If you have a good strategy and clear objectives, you can easily maintain your leverage until the deal is signed. Now be cautious and watch out for lowball pricing. Almost every vendor quotes a simple monthly subscription price when everyone who has ever negotiated with them knows it's always priced for 12 months and it's paid 1 year in advance. Don't get caught out with impressive sounding discounts on a monthly subscription only to find out that price is linked to a 5-year commitment. Insist on a reasonable shorter term, maybe 3-year pricing, but do it early in the game when there is lots of competition and more leverage. Then, when the timing feels right, and only if it makes sense, use that base price to move to a 5-year deal to get either much higher discounts or other more valuable concessions. Excuse me. Try and work into your initial agreement 1 or 2 12-month extensions at the same or even better price than when the initial term expires. There's no logical argument for annual consumer price or CPI increases that cannot be challenged by the fact that the cost of technology goes down over time. If you worked your best initial pricing based on 12-month blocks and then got some price concessions to increase to a 36-month deal, those original 12-month blocks sets a benchmark standard for your future 12-month renewal pricing. You might be promoted to a new job or have changed companies by then. This is how you set up your replacement or future buyers to negotiate a better renewal deal when the time comes. At the end of the first 36-month term or 60-month term, no vendor sales representative is going to settle for the paltry revenue from a 12-month extension when, if she offers another 15% discount, she might get a 36-month commitment and much more revenue for less work. If you're renewing with an incumbent software vendor and they are proposing a cloud solution instead of on-premises, it is the absolute best time to fix the overspending problems of the past. They don't want you to stay with on-prem. It's no longer a strategic product for them. They get paid very low commissions, if any, for renewing old software products. They will offer big incentives for you to go to cloud, but you need time to do it right and to be able to exploit the opportunity. If you're already in the cloud, you have practically no options when your vendor gives you 30 days notice of your renewal pricing. So try and start your renewal process much earlier. Don't accept 30 days notice before the end of the term. You can insist on at least 90 days notice in the original agreement or even longer. What good is 30 days notice if it takes 90 days to replace the vendor? If they tell you they can't because software quotes are only good for 30 days and prices are always subject to change, and you have knowledge and proof of the original list prices, just tell them to add a pricing schedule to the agreement. Detail the list prices in effect, your discount percentage, and your net price. Then, if there's an official list price change between the date they give you the renewal pricing information and your renewal date, they must provide you the general announcement letter, and you will accept the increase capped at some percentage. If there is no official announcement letter affecting every customer, then they can't arbitrarily raise your prices. Always keep in mind, your account rep can't see beyond the end of the quarter. She gets paid on making her quota. And if she's spending time with you, you're already on her forecast for that quarter. Know her quarterly financial deadlines. Salesforce, for instance, is January 31st. Oracle year-end is May 31. Microsoft, as I mentioned earlier, is June 30th. Adobe is December 1st, and SAP is December 31st. Always be thinking revenue recognition and how to capitalize on that. It's all the vendor cares about. What about storage? Digital transformation, artificial intelligence, AI, and the Internet of Things, IoT, are among the technology areas that create the largest amounts of data. The amount of stored data is currently doubling every 2 years. The digital transformation, AI, and IoT will cause the greatest exponential growth in storage requirements the world has ever seen. Storage is often ignored and may seem insignificant in many of your deals today, but the requirement will continue to go up and go up quickly. Vendors purposely leave storage out of the discussions and then slip it in at some astronomical price near the end. Here are my top 3 most outrageous starting cloud storage quotes. The first one was the most flagrant. $11 Canadian per gigabyte per month. I kid you not. Even their president, when I challenged him, said, "Oh, that must be a typo." My last iCloud storage plan was $4.50 per gigabyte for 200 gigabytes. That's 2.25 cents per gigabyte per month. Within the last 6 months, I did a deal with SAP in Switzerland. €1 per gigabyte per month. SAP was using AWS for storage. The AWS Frankfurt list price was 1/40th of the cost at 2.4 euro cents per gigabyte per month for the first 50 terabytes. 2 months ago, I did a deal in the USA, $1,000 for 10 gigabytes per year. That works out to $8.33 US per gigabyte per month, which was 333 times more than what AWS USA was. 2.5 cents per gigabyte per month, again for the first 50 terabytes. So I think we can all see the trend. No matter how the vendor tries to conceal the pricing, euros, dollars, Canadian or US, the bulk storage rate is less than 3 cents per gigabyte per month. Anything above that goes to vendor profit. Many of these cloud vendors don't have their own storage infrastructure. They use providers like AWS, Google, Microsoft Azure, Rackspace, and others. Why can't you do your own deal for storage? If your software vendor is taking advantage of you, why not have the option of during a renewal period to do your own storage deal? You're just renting space from a third party. What difference does it make who signs the lease? At least push for the option and use that threat to get more reasonable pricing and some future price protection. Be cautious of shelfware. That happens in the cloud too. Vendors oversell. They will sell you premium modules when lower cost standard versions will suffice. Many will have add-on features for a small incremental price. And vendors will oversell subscriptions, claiming you need to allow room for growth. So they try and get you to buy the subscriptions right away while the discounts are high. Now that should be a red flag right there. The vendor just said you have to buy them now and take advantage of the high volume, lower price, or you will pay more for them if you wait until they're needed. That warning must steer the conversation towards future price protection. If you negotiate good initial add-on and renewal price protection, when you still have leverage, you can completely avoid this shelfware trap. Sometimes you may even overestimate and overbuy some subscriptions, and perhaps not buy enough of others. The preferred alternative is, of course, to know exactly what you need initially and do a good job of negotiating pricing for more of the same type of subscriptions when needed, and add-on modules that possibly complement what you're buying initially. But it's not always possible. Sometimes you just don't know what you don't know. It wouldn't be a problem if you had pricing clarity on the exact cost per subscription by module per month. Then you work in the flexibility to add subscriptions at the same price or with a small markup after the start date as they're needed. That way you can buy less at the beginning and not be penalized with higher prices when you add on later. Or if there were high potential ancillary modules to add on in the future, you could at least negotiate price holds for a given period. Your vendor sales team will not like the pricing transparency. They're not going to like giving you any assurances against price gouging. More pricing transparency and granularity leads to more price points that you can negotiate. That cuts into your vendor's revenue. You must always put yourself in the vendor's shoes. Think about revenue recognition because that's all they're thinking about. You can get very good pricing and more agreement flexibility if you can find ways to add to the revenue recognition. That's why it's better to start the negotiations with very conservative volume estimates. It's in the cloud. Infrastructure is no longer a concern. The vendor can scale up easily. How can you mitigate your overbuy risks and not hurt the revenue recognition? You're never getting a refund. So if you can't buy real low and get same price add-ons, at least get some swap language in case you overbuy. This is a classic trade. Both parties benefit. It works like this. During the term, you give up your rights to certain prepaid subscription types, and you replace them for the remaining term with an equivalent value of some other more useful subscription types. The vendor will never allow refund provisions. They won't do it if you overbuy or they oversell, and they also won't issue any meaningful credits for missed service levels. If any of the revenue booked has the potential to be refunded to the buyer, the vendor cannot legally book it. You have to be creative sometimes to meet both parties' interests. Ramp up is another savings opportunity. Rarely are you going to need the full-blown inventory of subscriptions on the first day of the agreement. Why are you paying for them on day one? Your vendor account team will want to deliver the full capacity of subscriptions immediately, even if you can't use most of them until several months into the initial term. So either get another discount spread out over the entire term, or tack on 3 months of free subscriptions at the end, whatever the value of the wasted subscriptions add up to compensate for the extra shelfware during the ramp up. Just make sure your future end of term gives you similar or better leverage with another important vendor financial quarter coming up. Ever since March 2000 tech bust, Sarbanes-Oxley in the USA, and now the IFRS, or International Financial Reporting Standards, there are some pretty strict rules about how technology companies are allowed to recognize software revenue. There are 4 basic rules for software. There must be compelling evidence of an agreement. The pricing must be predictable. Collectability must be reasonably assured. And software delivery has occurred. Now, let me tell you a story about the first time that last one hit me in the face. The deal was with Salesforce. They are typically aggressive negotiators. It was a big deal with an 18-month phased implementation. We wanted to buy up to 200 Service Cloud subscriptions a year, but we wanted to ramp up the first 18 months as needed, and we didn't want to pay for shelfware. Salesforce was insisting we had to take the first year's 200 subscriptions on day one. An alternative we proposed was the further discounting of all 1,000 Service Cloud subscriptions over the 5 years to compensate for the year one shelfware. We had been going back and forth on several issues about how many subscriptions were needed, by when, and what happens if the project slows down, etc. When Salesforce agreed to give us an equivalent special discount off the total price if we agreed to no ramp-up credits and took all 200 licenses immediately. Well, the client liked the offer and insisted we take it. Then on the last day, when there are only a few issues left to negotiate, Salesforce made this seemingly magnanimous offer to settle the last points, and in trade, told us to take all 1,000 subscriptions on day one and use as many as we liked for the full 5 years. It's all about revenue recognition. Salesforce was able to claim the entire 5 years of revenue in that quarter because all the software was delivered. I'm sure this is no surprise to anyone in this room. Enterprise cloud solutions, despite the rhetoric, are not turnkey solutions. Most likely, professional services from the vendor, or more likely, one of their implementation partners, will be required to configure your specific unique layer that sits on top of the multi-tenant layer. Vendors want time and material engagements to perform these professional services because there is no financial risk to them. They just keep working and you keep paying until you are satisfied or you just run out of budget money. Fixed price deals usually come with a very large premium in the 40% to 50% range because the vendors aren't going to take any chances. Plus, if the requirements are loosely defined on a fixed price deal, then you, the buyer, suffers the added costs of change requests when those requirements do change. The number of hours required to configure cloud software that the vendor claims is mature and has been installed thousands of times around the world is at times incredulous. You have to start the system's implementation tasks, obviously with a good set of requirements in a statement of work or SOW. A requirement in the SOW will cost 0.5x. X is the negotiated hourly rate times the number of hours to configure the requirement. A requirement added during the implementation phase will cost 2x. And a requirement added after go live is going to cost you 3x. You have to ask your vendor for a breakdown of the implementation plan into its components. What professional services resources are working when and on what? The vendor project manager, the senior configuration specialist, the junior configuration specialist, etc. Resources times hourly rates, and you negotiate those hourly rates. I've seen hourly rates ranging from $125 to over $500 an hour. Just consider that for a moment. $200 an hour times 2,000 hours, a normal work year, equals $400,000 a year. I don't care how good they are or how much experience they have. The vendor is not paying them anywhere near that amount. And that tells you there's quite a bit of margin even at $200 an hour. Now, speaking of experience, you need to get resumes tied to the final rate quotes. The people who do the demonstration are always the top experts, but you don't get them on your project. Don't allow the vendor's junior people to train on your time at top dollar. Map the hours per week, per task within each phase. Make the vendor add your expected resource requirements, who will be needed from your internal team, and when. If you can't provide the resources when needed, the vendor will, but it will cost you more. Keep control over the costs through milestone payments. Failed user acceptance tests, or UAT, means work repeated for free, or at least at a heavily discounted rate. Always check and then define the priorities of each document that make up the agreement. The Master Subscription Agreement, or MSA, the addendums, the schedules, the exhibits to those schedules, the service level agreement, the statement of work, and the order forms, and then, of course, the online terms of service and privacy policy. And remember, a policy, no matter how official sounding, is not a legal obligation. Don't allow future order forms to alter the master subscription agreement without your express consent. Vendors give concessions due to the competitive pressure during the initial negotiation, and then they claw back on those concessions throughout the life of the agreement. You need to add a clause that forbids changes to the agreement unless it's signed by an executive of both parties, and the change to be legally effective must indicate the section heading by name, the specific section number to be changed, and the amendment must repeat the exact wording of the clause to be changed and then provide the new wording to the amendment. Here's a Microsoft example. A one-word change universally increased the amount of Microsoft Shelfware around the world. The Microsoft true-up language used to allow for spikes in usage throughout the year. You only had to true up for the licenses counted on the 12-month anniversary date. Adding the word any now meant that you had to true up to the maximum number of licenses used at any time during the previous 12 months. Let me tell you another story about an accounting firm that I had as a client. When we did the first enterprise agreement, or EA, it was signed in June, Microsoft's year-end, as mentioned earlier. So we got great year-end pricing. Then during tax season, March and April, license usage spiked way up. Then in May, it settled back down to normal levels, and only then did we file the true-up license counts, and it was perfectly legal under Microsoft rules. Don't accept online agreements. They can change at the whim of the vendor. Instead, print the current online version, make whatever changes you need to make in an addendum, and then attach it to the agreement as a schedule, and refuse to comply with any of the vendor's future online changes. Make sure there are contractual rules governing changes. To the vendor professional services team, they always promise you the A team, the experts who conducted the demos, then they deliver F Troop, junior people who spend half their time calling their own help desks for configuration assistance. The SOW requirements. Recall what I said earlier. A requirement in the SOW will cost you 0.5x. A requirement added during the implementation phase will cost you 2x. And a requirement added after go live will cost you 3x. There will also be audit language somewhere. Revise it to ensure there are no perverse incentives and conflicts of interest. An example of a perverse incentive is a payment to the auditor based on the dollar value of the software non-compliance found during the audit. An example of conflict of interest is the software vendor sending in the same auditors that audit your financial records every year. While not suggesting auditors are unethical, they are clearly in there to aid the vendor rather than you, the buyer. Add language to ensure you get a clear description of the audit process to be followed, the timetable to complete the audit, and state that an NDA will have to be executed prior to an audit. Now, my last topic is audit defense. In a recent UK study, 40% of company audits performed by third-party auditors were found to be substandard. We're talking about the Big Four: Deloitte, KPMG, Ernst & Young, and PwC. Imagine how bad they might be at software audits. What about that obvious perverse incentive? The auditors are being paid to find license revenue for the vendor. How much software audit business will they get if they don't find fault and return a profit to that vendor? Anyway, I'd like to wrap up now. So first, I'd like to thank Ben Losman and TechSoup once again for arranging this webinar and giving me the opportunity to share this time with you today. And if I can leave you with one final thought, the cloud brings with it many advantages. The vendors are scrambling for market share, and that creates opportunity for you, but you must be prepared. Start your deal early. Try and make it as competitive as possible. Time it for best leverage for the end of any quarter, if not year end. Identify your interests, set your priorities, and set your goals. And never sign the first deal if you can't predict what the second deal will look like. And above all, try and have a little fun with it. Thank you, and now I'll turn it all back over to Ben.
Thank you so much, Phil. Thank you for sharing your expertise with us here. It really is a pleasure to hear and to know that you're out there going about for the nonprofit sector. Just in the interest of time, we've decided to cut the Q&A session for this particular webinar. That just means if you do have any questions around this topic, please do get directly in touch with Phil using his contact information here. As you can tell, he's a very accessible guy. He knows a lot, and he's out there for us. So thanks again, Phil, and thank you, everybody. I hope you all have a really wonderful day.